Stealth tax alert. All full state pensioners to pay tax on their payments by 2027-28. A recent analysis from the Institute for Fiscal Studies, IFS, has sparked concern among pensioners, revealing that every individual receiving the full new state pension will be subject to income tax by 2027-28. This marks a significant shift from the current situation, where fewer than half of state pensioners pay tax on their pension income. The government's decision to freeze tax thresholds while the state pension value rises is driving this change. As a result, the full new state pension is projected to surpass the £12,570 personal allowance for the first time in history. The IFS predicts that this will lead to a substantial increase in the number of full state pension recipients paying income tax, rising from under 50% in 2022-23 to 100% by 2027-28. In last year's budget, Chancellor Rachel Reeves stated that she would not extend the tax threshold freeze, citing its negative impact on working individuals. However, due to the poor state of public finances, it is widely anticipated that she will reverse this position in 2 weeks. Freezing thresholds generates more tax revenue for the government as inflation and rising wages push individuals into higher tax brackets or above the personal allowance, without altering the headline tax rates. The IFS's new analysis indicates that extending the freeze by 2 years until April 2030 would yield £8.3 billion in that single year. The think tank emphasizes that the threshold freeze has already significantly influenced who pays income tax and the amount they pay. Critics describe this freeze as a stealth tax on pensioners, as it operates without a clear increase in headline tax rates. The implications of frozen tax thresholds extend beyond tax collection. Single pensioners relying solely on the state pension may become eligible for pension credit if their net income falls below benefit thresholds, leading to additional entitlements like free TV licenses. This could create administrative challenges for both the government and older individuals who must navigate complex benefit systems. The value of wage increases for lower-paid workers is also at stake. The Treasury would claim a larger portion of each pay rise through taxation, diminishing the real value of wage increases. The IFS criticizes multi-year freezes, arguing that the unpredictable inflation trajectory makes revenue outcomes uncertain and real threshold values difficult to determine accurately. Matthew Alton, a research economist at the IFS, stated that the tax threshold freezes have already represented a significant tax increase. Extending them would generate substantial revenue in a broad-based and progressive manner. A Treasury spokesperson defended the government's stance, highlighting the benefits of the triple lock, which provides pensioners with an annual increase of up to £470 and has led to over 57,000 additional pensioner households receiving the benefit, averaging £4,300 annually. Liberal Democrat Deputy Leader Daisy Cooper MP criticized the policy, describing it as an unfair measure that penalizes pensioners and hammers low-paid workers.